So, Mr. Steve, we have been talking about this day, it seems like for a year, and it's finally here. The CPI report of April 2023 has been released, and it is good news. So, let's talk about the impact that this report will have on the housing market and mortgage interest rates.
Yes, sir. And like all good economic news, it's always met with like much celebration. You know, people are like,
Yeah.
"This is good news," and you're like, "Oh, wait a minute." Like it doesn't make that much of a difference. But no, we finally got our CPI numbers back today, and we had some outlier numbers that came in higher than expected, that contributed to a little bit higher CPI number than we planned on. Which is okay. It came in better than estimated. So we showed that core inflation this year came down from 5.6% to 5.5% year over year.
I got the screenshot, Steve, if you want to talk that through.
So you see the headline inflation number, and this comes from our guy Barry over at MBS Highway, and they are the best at illustrating this on the planet with these slides. But we saw the headline inflation number came up 30.37%. So year over year, we came down to 4.9%, which is great. And then the core inflation. So the difference between these two, and it's important to note, is that core inflation is going to strip out the price of food and gas. It's got a lot of other stuff in it that is kind of variable, but food and gas we really can't control at all. That's controlled by OPEC and farmers and Mother Nature, who's confused as all can be. So we really saw some nice numbers. The one thing on that sheet that kind of threw these more than anything, though, is that used car number. And the reason why it made the CPI. I mean, mortgage-backed securities are up, between 25 and 30 basis points all day today, which is nice. That's like a quarter of a point in fees or 1/8% roughly in rate. So we're starting to see that. But the nice part is with this report is we saw the shelter number come down. I think it was 8.2 to 8.1 finally. So we're starting to see the shelter cost come down, rather than going up every month year over year. So that in that number, we can see what those rents are. So it is down. That trend is going to continue to go down. Like that data is already there for us to forecast, right? And so that's really the bright spot. Yeah, was it as massive of a change as we were hoping for? No, because you get that used car number in there. The good news about that used car number is that it's like that's really like all it's going to do, right? Like that's not going to be like they're not going to continue to go up at that same rate month after month. So that'll be less of a contribution to that CPI or that core CPI number. So really seeing that shelter cost change. There's some wage information that came out from a ZipRecruiter survey today that's showing a decrease again in the wage pressures that are helping us out. So really positive move for the mortgage-backed security market.
Well, and a couple things to expand on this is that last year when rates, went way up, as inflation went up, as I'm showing this graph on screen, we were saying to people, and we were getting great information from Barry over at MBS Highway, and that is, listen, guys, we know that this is going to be heartburn. We know that this is going to just be really bad for the housing market. It's going to be hard for people in the industry. We have to get to April. We have to replace this April number that I'm showing on screen, Steve. And that is exactly what happened in April 2023, that we replaced the number of April 2022. And we knew that this was going to happen, that we had to be patient. And now, all of a sudden, rates were already trending downward. But this is why this report was so highly anticipated, was because what I think the people that have been touting, interest rates are going to go to 10%, what they missed was exactly what happened today. That today's report replaced a very, very important number 12 months ago. And that number now will continue to go down based on some of the things you just said. Yeah, I mean, you take used cars out of this. I mean, we would have been drinking champagne on this episode.
Exactly.
And so as that number continues to go down and down and down and down and down, we anticipate and this is what people said were crazy, and now maybe not so much so, that interest rates in the summer probably going to be in the low fives. And here's the
Possibly, yeah.
thing. Here's the thing. If that happens, which we believe it will, just like we said a year ago, we could be wrong, but here we are today saying a little bit of a "I told you so" to all the fear mongers out there. If that happens, now something magical happens to the housing market, and that is this: buyers and sellers have perspective that have replaced a year essentially of high interest rates. Here's what I mean. Of course, it makes sense that we come out of a market at interest rates at 3.5%, 4%, and they go up to 7%. Of course, that pauses everything. Of course, mortgage applications are down. Of course, home sales are down. But what happens when you get on the backside of that perception? What happens when you go from a 7% market to a 5% market? Well, then a rebound takes place, because now we're coming out of a high market rate environment into a low market rate. And all these people that have been on the sideline for the past year say, okay, I know what it was. It was 6.75. It was 7.25. Now you're telling me I can lock in at 5.25? Yeah, let's roll. Steve, lock me in. Let's rock and roll. Let's get this house thing going. I'm putting my house on the market. And I believe this summer, this housing market gets going. Sales start to come back up. And it will be a result of this first sign that came out today with the CPI report.
Yeah, I mean, from my perspective, and just having so many buyers out there right now fighting for properties, and it's the inventory thing, right? And we know that the only way to create inventory is to build homes, and housing starts are picking up slowly, right? And there's more builder confidence growing. But the other piece of this puzzle is that there's rate lock, right? And so I always like think gridlock in my head when I say rate lock, because there's a lot of people out there, and I have one right now finally buying a house, and she was like, look, I'm at 2.75. We need to get out of this house. Like, my husband's driving 55 minutes for work. We have 2 kids now. We have 2 animals, and we're like a 3-bedroom bungalow, and we're splitting at the seam. She goes, but our rate is so low. And now they're finally, right? So we're in, like, I think we're going to lock them today at probably a 5.99%. And they're finally like, oh my gosh, like, we're excited about that. Like, that works. They're moving, like, they're finally doing the whole thing. I mean, they decided like a month ago that they're going to sell a house under contract, and they're finally making that move. But she was telling me, she's like, I couldn't do it at 7%. She's like, I just couldn't go from under 3 to 7. I just couldn't do it. And so I think we're going to see a lot more than that, a lot more of that coming as time goes on. And that's going to help start to move some of this market. And as part of that, we're probably going to see values continue this increase that we're seeing now. So we saw those couple months of downturn in home values, which were like 0.1% year over year from literal all-time highs.
That's
like
right.
Values were going up like 22% a year, and they went down like 0.7%,
Yeah.
and from 22%. So you're still 22 and an eighth up, right?
Yeah.
And now we're starting to see these little percentages. Like, I'm seeing like a contract I got accepted last night. The house is listed at $289,900, and we're under contract at $325 with a $30,000 appraisal guarantee. So yes. there is that's coming, right? And that was like a big number for that block. So that's 10% over asking to secure that property. So we're going to hopefully, my hope is that as we start to see rates decrease a little bit and this perception changes, that it takes some of those people that are like, we want to move, but we're afraid to because we're locked into this rate. And hopefully that will start to kind of move like, what do you call it? Like Jenga? Is Jenga like we got to move
it's
things?
just
Like
it's just gridlock. I mean, this is a market where buyers and sellers are both on the sideline. They're just in a holding pattern, and this is I guess the pin that gets pulled that allows action to take place.
Right. And that's what I'm telling, other loan officers that are like, what are you doing right now? Like, what's your mindset? Like, I'm so turned off by the real estate world and everything right now. And I'm like, the saying like where the strong survives, I'm like, we're doing that. Like we're fishing in the storm right now. Like, you just You just got to wait this out. Like these things
Yeah.
will all move, but it's just our mindset right now is that, oh man, if I'm having a bad 6 months, then the next 6 months have to be bad. Nobody wants to see that there will be relief coming and there will be reasons for people to make moves.
Yeah. Well, the other big thing, yeah, I mean, you're building a pipeline, and that's the thing. I said this, I think, on an episode last week that I think the worst is behind us. I
Yeah.
think that things moving forward just get better. But the other thing that the CPI report that came out today does is we have to remember that the Fed, one of their major factors that they look at that determine, are we going to increase rates, are we going to hold, are we going to cut, is one of the major ones is core CPI. And the fact that CPI is really the first big factor that has concrete evidence that what they have been doing is working in that next Fed meeting, that's the other massive benefit of CPI coming out the way that it did this morning, was now all of a sudden we have a Fed that potentially goes into the next Fed meeting and doesn't raise rates again. Maybe even cuts. What are your thoughts on that?
So I mean, I highly doubt we'll see the rate get cut, but I think that, they're in their last meeting, they changed some of the verbiage saying that, the Fed rate decisions are now going to be based on, or their stance is now going to be data driven, where before they were saying there was like just a high likelihood that we were going to continue to firm and strengthen the economic tightening and economic financial or fiscal policy. Where
Yeah.
now they're saying it's more data driven. Well, so that came out on Wednesday. Well, on Friday, we got the unemployment report, which came out much stronger than expected, right? We were hoping for 180,000 jobs, came out at 253,000. But at the same time, they went back and revised the two previous job reports, which the Fed was looking closely at, and decreased those by, what did we figure, like between 25 and 30% of those jobs were
That's right.
removed from those reports when the Fed came back, or the BLS came back and revised those numbers. So it'll be interesting to see that next jobs report, how they revise this jobs report, especially if we're looking at it from a data-driven perspective. And I do believe, I don't have the dates off the top of my head, but I do believe we're going to get another jobs report, which will give us the new numbers, and it's going to give us any revisions from last jobs report. Plus, we're going to get PPE, which is producer price, or PPI, producer price index, which is the price that these large companies are paying for goods. And then you're also going to get CP, personal consumption, or PCE, personal consumption expenditures, which the Fed also looks closely at. And hopefully some of those things will start to see these numbers go down. One number that really is kind of funky factoid thing that really played into, if you want to think about how inflation, we're seeing inflation going down, but we're like, things are still going up in price, right? And one of the ones that came in higher on this CPI report was auto insurance and insurance costs altogether. And if you think about this, is kind of an interesting perspective, and maybe it helped kind of open my eyes to it a little bit, is some of the lagging effects of inflation. So while inflation's going down, you have to think these insurance companies, say you wrecked a car last year and you're paying these higher prices, right? You're paying inflation that's up at 9%. So this insurance company, your rate was based on your driving record and repair costs and all these different actuaries, risk analysis and cost analysis. From before that is what your rate was based on. You smack, your insurance company gets smacked for a bunch of these cars. And now coming in this year, they're looking at those actuaries, which are financial analysts, right? And they're looking at it and they're saying, okay, like this is what it cost us to repair cars the last 2 years. We need to start to recover some of this cost. So now we're going to start raising auto insurance policies. And this is why the Fed thinks that it's so important to fight inflation with such a strong hand right now, is because you're going to see this like corn prices, and you're going to see this in all these different prices of things that go into the goods that we consume. And now it's coming into like your services, like your insurance. Like, why is my insurance going up? Because steel was really friggin' high last year, and they're paying for car parts that are made out of these higher priced goods. So just kind of some perspective on why it's so important that we fight inflation as aggressively as we do.
Absolutely. And the other thing is that so the next Fed meeting, and you said this, is on May 2nd. And we won't get another CPI reading until June 13th for May's reading. So they're going to go off of this. And then the other thing that is playing to this is the jobs report. And that is why what the report from ZipRecruiter today will potentially have such a big impact is that the unemployment is also a lagging indicator that takes a while for that to be impacted. And so if that next jobs report, Steve, as you know, comes out and it isn't the way in which the last one just came out, that will be another reading that the Fed will have to take into consideration. In other words, what ZipRecruiter came out and said as well is like, listen, things aren't as great as they have been because it takes a while for that to appear. So they got to take that into consideration. New jobs report. They have the current CPI, which is their biggest hindrance on what they do in the next Fed meeting. These are all the things the Fed are going to have to consider in that meeting on May 2nd. And so
the next Fed meeting is actually June 13th.
Oh, June 13th. Yeah, I'm sorry. Yes.
May 9th. I'm sitting there, I'm like, May 2nd. I knew they got one more jobs report in there before then. So
yeah. So it'll
the
just
next job report is out June 2nd too, which will be another good one. It's like I'm saying, it's nice to get some of this data. They're getting two sets of the most important data before their next
That's
meeting.
What I'm saying. That's right.
So going back to original point, raise, pause, or cut. I think that, who are we, right? Like we're just a couple guys that are out here, trying to report on just some of the basics. Yeah. But I do think that the way I see it is in based on what their press conference, and even if you read some of the Fed minutes, I do think that they ultimately want to get to a place where they can pause. Like they realize that this continuing to raise rates is stressing a lot of these banks. And there's the as much as the Fed wants to destroy demand, they still are trying to engineer this where we can softly land into a recession. And so I think that we will, I think that there's a far greater likelihood of them pausing, raising rates at the next meeting than raising rates or cutting rates. So it'd be great to see them cut rates. I know a lot of the, there's a whole market for predicting that and things, and they do. A lot of the markets are still counting on, even though the Federal Reserve said we are not going to cut rates this year, the markets are still counting on 2 rate cuts this year. So it should be interesting.
Well, yeah, because I think a pause is very likely because you've got another 30 days or so for us to see what they have been doing coming out in future reports. It's not an instant, thing. And so I believe that the reports coming out over the next 30 days will reflect what the Fed has been doing. And if it comes out as we expect it to, then the chances of a pause are very, very high. And if they pause, then things will react even better and we start to get a snowball effect. And that's why we think the summer ahead of us is going to do what we said it was going to do. So it'll just be like, to your point, it'll be interesting to see what happens. So if people are in Michigan and they need a mortgage this summer because rates are going to fall, there's nobody better than you are. So what is the best way for them to contact you? Or would it just be easier, Steve, if we just put your contact information underneath this video?
Pop it below the video. And even if you're out of state and you have just some questions around some of the stuff, or you want somebody to bounce things off of, like, don't hesitate to reach out. I'm always around.
Yeah. Appreciate you, Steve. Appreciate all the insights. And, it was good news. This is what we wanted to see. This is what we've been waiting to see literally for a year, that we've been saying for a long time. It's like, we just have to replace April's data from 2022 and what came out today, which would have been better had you taken out the used car market. Right. It would have even been better today, but nonetheless, still good news. And we appreciate you very much.
All right, man. Thanks.